Hey guys, so you've probably have been taking trades and you've been eating SL most of the times. So it's not your fault. There are things in the market that happens that you actually don't know about. Now, if you have been trading support and resistance levels, yeah, this is one of the things I want you to take note. So, so guys, there is what we call liquidity. Now, the liquidity is what fuels the market. Is more of like petrol, just like a normal car petrol. It's something that fuels the market. It's what moves the market. Without liquidity, there will not be market movement. So you've probably been taking a lot of losses these days. Let's say you're trading support and resistance. You observe that you get stopped out, but eventually markets going towards that direction you were planning to go, or you were planning to like take your profits. There's probably one thing you don't know about, and that's what I'm going to explain today. If you're watching this, I want you to stay with me till the end of these videos, because if you're done watching it, you notice that you'll be taking like few losses most of the time. So keep on watching. So now there is what we call liquidity. Just like I said, liquidity is what fuels the market. It's just like the petrol of the market. It's what moves the market, right? So there are four kind of liquidity we have. We have equal high liquidity, equal high liquidity, equal low liquidity, trendline liquidity, and then what, range liquidity. Now I want you to focus on these two, this equal and equal low liquidity, because is what you'll be seeing most of the times. But I'll also explain this one and this one. Now on equal high liquidity, what it means is that now for liquidity, it means there will be liquidity around this area. Why is there liquidity around this area? It's because many traders, many support and resistance traders will be placing their trades here, right? Like this market, let's say, is a downtrend, so many supports and resistance traders will place their orders above this level, or maybe their stop losses will be above this level, right? So if their stop loss is above this level, let's say you're selling the market and your stop loss is above this level. Now for liquidity, the reason why I say there is liquidity here, where do you find your liquidity? Where there is what is support and resistance. Now the reason why I say there's liquidity here, many retail traders will have their stop losses here, and many also have their buy stop orders here in case the market breakout orders. And we also have those retail traders who have their breakout orders, and those who have their stop losses below this level, and those who have their stop losses below this level in case the market breakout. So now there is one thing I want you to notice. Now if you observe, like, there is what we call the institutional traders. These are the market makers, the big guys. Now they know that many people here will be placing their orders here, right? And these guys, they can't just enter the market randomly at let's say at random prices. They don't do that because they won't make any profit. So they mostly target areas where they know retail traders are mostly concentrated. Now if you observe this area, there are many people placing their orders, their stop loss, their buy orders, their buy stop orders, their sell stop orders. Many traders are placing their orders here. Now what these guys do, these institutional traders, the market makers, what they do is they make sure they target these areas. Now for this, let's say for example for this one, now if the market is a downtrend and you place your order here and your stop loss order here, you risk getting like stop out early. Why? Because retail traders will make sure the market will take you out of the trade before it begins to drop. That's what we call liquidity sweep. That's why many times you observe you place an order and you get stopped out early, and eventually the market go the way you were thinking. So this is what these guys do. They make sure they target where retail traders are. So it means it's just like you are the liquidity for them. They need your money, and they need your order to fill their orders. So it's just like you're selling them your orders at a discount price, you get. because they'll be buying it at a cheaper price, right? You'll be selling it to them at a cheaper price. That's that. So they need this to avoid slippage. If they don't do that, they're playing with big amount of money. So if they're just buying randomly, they'll like gather a lot of losses, and they don't want that. That's why they target all these retail traders. So many people here will be taken out of the trade before the trade eventually go down. So take note of equal high liquidities if in case you are trading support and resistance. Also, I'll show you the kind of strategy I use and how to like spot my liquidity zone. Now on equal liquidity, you should observe this is an uptrend. Let's say this market is buying, right? Our liquidity is situated around this area. Our liquidity is just below this area. Now many retail traders will have their stop loss below this level. Now you will observe that most of the times if you have your stop loss below this level, you get stopped out before the market begins to go up. That's what we call liquidity sweep. As I said, the market makers need your order, all these retail traders orders, before they can fill their order, because they are playing with big money. They can't just like buy at a random price. They target certain key areas where they know retail traders will be concentrated to fill their orders. They need this to avoid a huge slippage. Slippage is just like you buying something at a high price, and nobody wants that. Everybody in the markets, we are all here to make money. So take note of that. We have equal high liquidity and equal low liquidity. So observe when markets sweep the liquidity first before you should look for your entry on this. Now we have trend line liquidity. Trend line liquidity is just like a trending market. Like, yes, if market is trending, definitely there are many traders who have their stop losses above this level, right? Many traders will have their stop losses above this level because the market is selling. Now many retail traders get stopped out before the market begins. Eventually market will stop many traders out because they don't know what is liquidity. And every single time liquidity sweep occurs, because market will always need liquidity to move. That's what we call liquidity sweep. It's just like the fuel for the market. Market needs that for market to move. So always know where your liquidity levels will be, either the support or the resistance level. Always look for that liquidity sweep. Now, just as I'm saying, you need to like know where this liquidity sweep occurs. But I'll talk more on that later. And the next one now, the last one we have is a ranging market liquidity sweep, just like the normal support and resistance I'm talking about. Now ranging market, there will be liquidity above this level and there will also be liquidity below this level. Markets will always need liquidity. So many people who are selling here will place their stop loss here, right? Eventually markets will end up stopping many of them out before market calm down. Also, many buyers who are waiting for the market to rebound will have their stop loss orders here. Now markets will come down to fill this order, to take their order and stop most of them out, to give room for market players or the market makers to get their entry, and market will begin to buy. So that's that for liquidity. Except we have 4 types of liquidity. We have equal high liquidity, equal low liquidity, trend line liquidity, and then we have what? Ranging market liquidity. Now where do this liquidity occur? Liquidity occur around where? Around swing areas. Now if you observe, this is a swing level, right? This is a swing. This is a swing, right? So liquidity, always look for liquidity around your what? Around your swing levels. That's where liquidity mostly occur. I'll show you that, how to identify that on a real life chart. Now if you observe this level too, this is a swing level, right? This is a swing low, this is a swing low. So liquidity occurs around these swing levels. And on a trending market too, swing level here, there's also liquidity around this area. since this is an uptrend, you might see market sweeping below this before it keeps buying. So now let's go to a live chart and let me show you how you can identify your liquidity. Now I'm on a 15-minute time frame, but if you observe, we have swing high, swing low. This is a swing low, right? If you observe, this is a swing low. If you observe, this is a swing low. Now many stop orders will be placed above this level, and what do you see? Market sweep this liquidity, taking them out, right? Actually the market is an uptrend. If you observe, the market is going up, but it's kind of like in a temporary downtrend because it's unable to break above this high you are seeing. But if eventually market break this high, which it does, you see it broke this high, after taking this liquidity sweep and sweep it to the what, to the upside. Now liquidity sweep is very good if you can identify it, because you mostly catch where the big guys are buying, and if the big guys are buying, they are injecting a lot of money into the market, and that's where the big moves occur. If you catch that, that's big money for you. So it's very good, you should know how to identify your liquidity, where liquidity is always situated. Now another example, now here we have a swing here too. This is a swing low, right? This is a swing, this swing level, this swing level. And what do you see market do? Market came down, sweep that liquidity. It sweep that liquidity before it what keeps buying, right? Also market will eventually come down again to sweep the liquidity if possible again. Since this is a swing low, now this is a swing high. Now we're actually on an uptrend. Another example, we have this one again. This is a swing high, low, high, low. This is swing level. If you observe market, let's draw our line. There will always be sweep of liquidity. Just as I said, market needs that to fuel itself, to make these big moves. You see, this is swing low. Market came down, swept that liquidity, taking most buyers their stop losses, taking orders, all those things. It came here, take the orders here to fill that order before it begins to what, to run to the upside. You can see this big move. So always look forward where there is what, liquidity sweep, to catch your big moves. Now let's look for another example. Liquidity sweep always occurs as well as at swing levels. Now this is a swing, this is a swing low, this is a swing low, and what do you observe? Market came down, sweep this liquidity before it begins to what, buy. So liquidity level is always available in the market for you to see, and it doesn't matter what time frame it is. It happens in all kind of like time frame, either 1 minute, 2 minutes, 5 minutes, any time frame. You can find liquidity sweep in any time frame, guys. So if you're getting stopped out early during your trades, let's say you are trading support and resistance, it's time you start looking for your liquidity. If you don't know about liquidity now, I guess you know what liquidity is all about, and I'm certain you've learned something, one or two, from this video about liquidity sweep. So guys, don't forget to subscribe, like, and share this video. Let me know in the comment section if you find value in this video and what you want me to like make video about in my next video. Thank you for watching, guys. See you in my next video. Peace out, guys. Thank you.